more time trying to acquire that trading style or actually understanding the market much better. If you are taking signals, please ensure that you have a properly funded account. Taking signals with a very small account is actually very pressuring, and you, the individual that is actually trading, and a lot of signals provider will not tell you this because they want to just take your funds away from you. Alright, what's going on everyone? Welcome back to my channel, Engine Trading, and most definitely, as you guys see within the title, for today's video I'm actually going to go ahead and break down how is it that you trade with a small account. So if is it that you're actually just getting started within the forex market, or you're actually been in the market for quite some time, however you are having some slight issues with risk management and stuff like that, or perhaps you heard other traders mention stuff like trade 10% of your actual account balance, but you never really get a visual explanation as to exactly how to go about doing this, then this video is definitely for you. With that being said, please be reminded I'm not a financial advisor. I'm just a regular guy on YouTube who actually loves trading and actually sharing my information with you guys. So with that being said, don't forget to like, comment, and subscribe. Is that you're interested in seeing some of my past trades or see how I go about trading the actual forex market, please check me out on Instagram at engine trading underscore. And if you're actually interested in signals, you can hit me up on IG as well. With that being said, let's dig into this chart. Starting off with a small account. When I said small account, I'm mentioning the range of $50, $100, perhaps even $200, or just keep it anywhere between $100 to $500. Anything within that range, I would actually consider that as a small account. And the reason being is that the lot size that you guys would actually choose to trade and that particular account will actually determine if it's that you blow that account very quickly, or you actually can lose a few trades, but it also puts you within the position to take some more trades and actually try to recover from certain losses. You don't have to be profitable in hard trades. However, if you have a good risk to reward ratio, then you can be profitable in a few trades, and that will actually push your account in a lot of profit. So always try to maintain a 1-to-3 ratio when it comes to trading. For instance, when I mentioned a 1-to-3 for this first trade that I did send out, the stop loss on this trade was about 26 pip, called about 26 pip, and the take profit area was 151 pips in total. So you see the risk to reward ratio with respect to this trade, this is far greater than that of a 1-to-3. So this is a very high profitable trade. And also I did send out another re-entry on this particular trade, which the stop loss was about 18 to 19 pips and the take profit was in the range of 80 pips. So another re-entry of the same direction and the same trade. However, each of them was over that of a 1-to-3. So even if it's that I am so profitable on this trade but I tend to lose on next trade, then because of the profits on this one, I maintain that higher risk to reward ratio, which keep my account within positive, within more profit. And also to give you guys a clear example of if it is that you're trading with a account, say it is like $200 or in the range of like $500. So the stop loss on this particular trade was 25 pips. Just use 25 pips. I'm just going to jump over to a pip calculator real quick so you guys can see exactly what it is when selecting the correct lot size. So that currency pair that we're actually trading was GBP AUD, and the pips movement was 25 pips. And if it's that your account is $500, you actually would want to be trading a one lot on that $500 account, because as you can see, that one lot will actually cost you to lose $174, provided that the trade went into opposite direction. Then out of your $500, you will actually lose $174. And if it's that you had a small account of say $200, and then you pretty much wouldn't even be able to trade or to place another trade. And this year I'm probably using like a high leverage 1 to 1,000 based on the broker that you're actually using. So for a $500 account, I would actually do suggest you stick within the range of say 0.2, say a 0.2. So basically it's like you're risking like $34 on that part on each trade. So if it's a 0.2, it actually costs you to risk $34, and then our profit was, I think it was 150 pips in profit. And then your overall profit target here would put you in the range of about $209. So risking $34 for $209 is actually a very good risk to reward ratio, and it also keep your account in check. Should in case you did lose this particular trade, then you'd actually be in the position to be able to do or to place several more trades. if it is that you had a $200 account, on your first trade will put you in the range of losing $34. Though you might be able to place like 3 or 4 more trades, provided that you end up in a negative situation. Losing $34 on a $200 account, I think, is a bit too much. I think within the range of, like said, 15 to maximum like about $18, which is on the high side as well, will actually keep you in the range. So selecting a lot size for like a $200 account, then you should probably jump down to the range of like 0.1 on that account. You have to be very patient, and that is the thing that affects a lot of traders. They come within the market expecting to flip a account as quick as possible, but if you actually want to be in the game for the long term, you have to be very patient and watch your profit stacked up over time. And as your account gradually grow, then you increase your lot size along the way, but you have to be patient for a small account. And if you get to the range of like say $1,000, then you probably can bump up your lot size in the range of like 0.4 or 0.5, because it's a little bit more aggressive. I would do suggest sticking in the range of like 0.3, 0.5, 0.4, somewhere around there, losing about $69 on a $1,000 account. That's a good risk to reward ratio. If it's that you're targeting say 150 pips, then you have a potential of getting $418. So you should most definitely take into consideration as well what amount of pips is it that you are targeting. So please have a proper trading style that give you a risk to reward ratio of that which is greater than 1 to 3. The greater it is, the greater potential of you making more profit and actually protecting the trade that is supposed to come afterwards. And for currency pairs such as gold, jump over to gold chart real quick. Gold is a bit more different, or it's a precious metal, so it is not like the other currency pairs, so you do have to be very careful when trading. For instance, the stop loss here is in the range of say 462, and my take profit is in the range of, let me pull the screen down a bit, my take profit is in the range of 3,116. So gold does pays out a bit more than that of the regular currency pair that you do trade on forex market. So slight movement such as this, which was just a double check right here, which was 454 pips for a stop loss. Let's jump over to gold real quick. So right here, this is gold. It's 454 for a pip on gold, and if it's that you're trading 0.4 on gold, then you would actually be risking $181. If you're trading a small account and you're actually trading like a 0.09, then you actually will be risking $40 on this particular trade. I think the take profit was about 3,100, so say 3,100 for the profit, then you'll be looking at $279 for a profit on a 0.09 trade on gold. So don't be as aggressive. Like if for instance you're actually trading like a 0.3 or 0.4 on your $500 account, and the regular currency pair doing the same on gold will actually put you in a very bad position. This would actually be good if it is actually a trade run within profit and you did acquire that trade was 100 pips. However, if in the event that you did lose the trade, and say for instance that was 454, you'd actually be losing $181 on this particular trade. So a lot of traders are aggressive and they tend to try to flip their account as quick as possible because they actually do trust their trading style, so they would actually tend to ramp up the lot size in which they trade with. However, if you are just getting started, be patient. Patient will take you a very long way. It also provide you an opportunity to stay within the market so you can learn additional information that can help you to better your trading skill. So guys, hope this video was helpful and hope you actually see with regard into selecting the correct lot size for a particular trade setup will put you in a better position. And if is it that you don't have a trading style, I think you should actually spend more time trying to acquire that trading style or actually understanding the market much better. If you are taking signals, please ensure that you have a properly funded account. Taking signals with a very small account is actually very pressuring, and you, the individual that is actually trading, and a lot of signals provider will not tell you this because they want to just take your funds away from you. So if you are trading signals, you are not the one who's actually looking at the charts, and you are not the actual one that is doing the setup. So that puts you at a disadvantage already. So if you don't have a properly funded account, you won't be able to make changes, come out of the market should in case you do see something wrong with a particular trade. Basically, you are 100% relying on that signal, and trading with a very small account with no proper risk management is very bad. So please have a properly funded account if you decide that you want to take signals, so that you can take a lot of pressure off you, the individual who's actually trading it. That's it guys, and I hope you guys did appreciate this video. And if you did, please remember to like, comment, subscribe, and share this video with your friend. Let's get it.